in gold too, the third consecutive monthly increase, China, 17 straight months in a row, but their imports rose to 162 tons in March, the highest since March 2024. Third consecutive monthly increase, higher, 17 months in a row of consecutive stockpiling. So yeah, you got the central banks, and in particular China, who use the stupidity of the CME Group's margin hikes by 300%. To at the same time the ETFs were being rebalanced, to say, great, thank you, we will gladly take that subsidy and stand for delivery. The same thing is happening on COMEX.
China's demand for precious metals has surged sharply in early 2026. In March alone, silver imports jumped around 78% month-on-month to a record 836 tons, far above seasonal averages. Gold imports also strengthened during the same period, with wholesale demand rebounding as investors and central banks continued accumulation despite price volatility, showing that physical demand remained strong underneath market fluctuations. Leading precious metals analyst Andy Schectman explains that the sharp decline in gold and silver prices earlier in the year was largely the result of market mechanics rather than any deterioration in underlying fundamentals. He notes that aggressive margin hikes by the CME Group, combined with forced ETF rebalancing, created significant selling pressure and triggered widespread liquidations. Despite this, physical demand remained exceptionally strong, particularly in China, where gold continued to trade at a premium and silver imports reached historic highs. He describes this divergence as the Shanghai flip, highlighting a disconnect between paper-driven price action and robust physical accumulation. Furthermore, Schectman points out that substantial deliveries and ongoing withdrawals from COMEX reflect a structural shift in the market, with large and informed participants removing physical metal from the exchange system. In addition, he observes that major institutions, including Wells Fargo, UBS, and JP Morgan Chase, are increasingly projecting higher gold prices and reallocating toward commodities. This development signals a broader shift in capital flows, with investors gradually moving away from conventional asset allocation. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Andy Schectman's recent interview.
In my mind, it is staying the same. I read an article yesterday, and I like the way they titled it. They called it the Shanghai flip. Now, I've talked a lot about this, how in January, when gold and silver both crashed, a flash crash, you could call it, from its all-time high. Let's start with gold first. In Shanghai, it was trading at a premium of between $50 and $80 an ounce. What that tells me is the exact same thing that the Bank of International Settlements came out and said. And in other words, the leverage speculators were facing massive margin calls because they raised margin rates by 300%, they being the CME Group. At the same time, it's like the worst time to have done that, because they knew that the first week of January, all of the levered ETFs have to rebalance. And they were way out of whack with the massive rises we had been seeing week over week into the end of the year. So you rebalance the ETFs, so you have to sell the stuff to rebalance it. At the same time, they've raised margins. In other words, it was orchestrated is a strong word, but it was structural, not fundamental. The BIS came out and said that. They're like, listen, nothing's changed fundamentally. This was a structural collapse based upon the mechanics on the CME Group, the COMEX. So with that in mind, this Shanghai flip, the central banks were continuing to buy hand over fist, but in February and in March, China imported the most silver ever for 2 months in a row. February was the highest month they had ever imported, ever. March beat that. So their silver imports rose by 80% nearly month over month.
It almost doubled in a single month?
Yes. And so that was into March. And silver in February was huge, but March was even bigger. And so it's 173% above the 10-year seasonal average for March. So, and go back and look over the years, you're almost 200% above normal to what they normally buy. Their year-to-date silver imports are up to 1,626 tons, the highest on record. Now,
Wow. All right.
this
So
is
I was
when
very
silver was
prescient
getting
then.
its teeth kicked in. Yes,
So
absolutely.
the global rush for physical gold and especially silver is indeed seeming to go into
but
overdrive.
in gold too, the third consecutive monthly increase, China, 17 straight months in a row, but their imports rose to 162 tons in March, the highest since March 2024. Third consecutive monthly increase, higher, 17 months in a row of consecutive stockpiling. So yeah, you got the central banks, and in particular China, who use the stupidity of the CME Group's margin hikes by 300% to, at the same time the ETFs were being rebalanced, to say, great, thank you, we will gladly take that subsidy and stand for delivery. The same thing is happening on COMEX. You're seeing, massive deliveries on COMEX too. We talked about the February. Again, let's look in February. In February here in the United States, when the price got collapsed, you saw 25.5 million ounces delivered on COMEX, but nearly 39 million ounces get loaded out, meaning leaving on trucks 2 million pounds, and it left the COMEX. 2 million pounds on trucks. Who's taking that, and where is it going? This is the same thing we've seen every single month. And that is the story that the mainstream has missed, Adam, is that price, all of the things around it are distractions, misdirections. What betrays everything are the deliveries and really the loadouts, meaning it leaves COMEX. And when you take 39 million ounces in 1,000-ounce bars, which each 1,000-ounce bar weighs 60 plus pounds, and you're taking closer to 70, you're taking 39 million ounces and putting it on semis and driving it out of the ecosystem, they'll never come back. They would have to be drilled and assayed to get back in there. That's a sophisticated to the nth degree investor. That is a wealthy to the nth degree investor or investors. And that's someone who knows how to run logistics, take care of insurance, and then unload those trucks where, for what? And, your mind's eye can wander, of course, and you can try and guess. I think a lot of it is the U.S. government, the Exchange Stabilization Fund. Bissett knows gold. It was his largest holding as a hedge fund administrator. It's unusual, and it's very unusual. And so the bottom line is simply this: everything else be damned. When you see the most well-funded and well-informed traders on the globe, from China to the other central banks to our own COMEX, seeing these kinds of deliveries, that nothing else matters. I mean, as crazy as that sounds. And one other thing, you got Wells Fargo sees a potential for gold to move to 8,000 by 2027. UBS, JP Morgan, Chase, Deutsche Bank, and the Bank of America are all targeting 6,000 plus in the next 12 months. Of course, we talk about Michael Hartnett. We've talked about him before, the chief analyst for Bank of America. I told you he says 25% allocation to metals should be at the expense of selling half of your bonds. He goes on to say, Hartnett says the next phase of the decade will shift from stocks to commodities driven by geopolitical disorder, inflation, and risk. Now you got BlackRock pivoting. BlackRock is moving away from their 60-40, as Hartnett had, as has the chief analyst for Morgan Stanley, who said sell half your bonds, put it in gold. They say the traditional 60-40, we're moving away from it, increasing exposure to commodities, including gold-related assets. So you're beginning to see big institutions now quietly, because most people don't pay attention to that. That's just small print somewhere at the bottom of the financial section. On top of all the deliveries, you got the banks saying, yeah, this is where it's going. Now, people wouldn't even notice that because it got collapsed, right? But the BIS says this isn't collapse. This was structural. This was all orchestrated by margin increases and rebalancing of ETFs. Everything is still in place, and you can see it through the deliveries and quietly through the admissions of the banks, who don't want to say, well, we told you, you didn't listen. They don't want to be, where were you when all this was happening? Well, they don't want to get yelled at. We did tell you, didn't you see it?
During the interview, Andy Schectman explained that the move toward de-dollarization became clear as central banks began increasing gold accumulation and rethinking where their reserves are held. He notes that institutions like the Deutsche Bundesbank and others have started shifting away from reliance on foreign custodians. According to him, this reflects rising concern over counterparty risk and signals a broader shift in global financial trust. Regarding gold and silver investing, Andy Schectman explains them as long-term stores of value meant for wealth preservation rather than short-term trading. Looking at market conditions, Schectman highlights that the silver market is tightening as supply faces growing pressure, especially with China restricting key inputs used in copper mining, which directly impacts silver production. He notes that ongoing deficits between supply and demand are becoming more pronounced each year. Silver's true value is being masked by distortions in paper markets like the COMEX, despite its critical role across multiple industries and rising global demand. In his view, this imbalance supports a strong long-term bullish case for silver. Let's jump into the interview.
That's really, Adam, what alerted me back in 2017 to this trend of the beginning trend of de-dollarization, of accumulating gold and silver on behalf of countries is a big message. But when you see the Bundesbank, the Bank of Austria, Hungary, Turkey, Poland, the Czech National Bank, the Dutch National Bank, all say to the New York Federal Reserve and to the Bank of England would give direct access to the LBMA, 140-year-old metals market, and the New York Fed direct access to the COMEX. It's convenience. You want to put your metal on the exchange, buy, sell, we'll keep it here for you safely. Mm-hmm. When they say, you know what, we prefer physical possession and removal of counterparty risk over convenience, that should tell you something. And yes, we've seen India do it, and now we see France do it, where they say, look, send us back our gold. But in this case, because the coin melt gold does not meet global standards of 999 pure, 24 karat, they did it that way. But it's an indictment when our allies are saying, yeah, we don't, we would much rather have the real thing than let you hold it. We'll forego the convenience. It's eye-opening, and people should pay attention. And I think most people, everyone has different priorities and agendas. For me, when I buy gold and silver, I'm hoping I never need to sell it. Now, I'm not saying people need to do this. I'm just saying I hope to give it to my children someday. It's there if you need it. If you're looking at a short-term in and out to capitalize on price, there are more convenient ways to do this. Now, I will say this, and I really need to be careful with this because I've talked with you a little bit about this. I'm working with some people to address a lot of those concerns, to find less friction, to find a way to collateralize, to find things that inspire confidence and trust. The industry is moving this way. Let's just say digital forms of gold that are redeemable down to 1 ounce, and everything from soup to nuts in terms of who's storing it, who's auditing it, is it deliverable, what is the cost of storage, oh really, what is the cost of purchasing, are you kidding me? Those kinds of whoa, it's coming, right? It's coming. And it's coming across, there's many groups that are trying to perfect this. These things will be addressed, but I will simply say to you this, that from a standpoint, when I tell people that I know that own businesses, how much money we make on a percentage basis, doing almost over 900 million in sales, and you only made that? Are you kidding me? Really?
Very low margin business.
It's very low margin and a lot of risk, especially over the last few years, where premiums have literally become schizophrenic. So, I get the point. And a lot of the things that people are saying are based just upon if I sat down with that person and we sat down and had a beer and I could tell him and be completely transparent, that person would change what they're saying in 1 second. Oh, I get it now. So yes, there is bid and ask in everything you do. And I think lately what has happened with premiums accentuates his point, but it's not controlled by us. It's controlled above us. The primary mint distributors are the ones that control that. And when you have the CME Group come in and jack up margins by 300%, so in December, it cost me roughly $15,000 to hedge 5,000 ounces of silver. And we have normally 2 million ounces or more in our warehouse. You got to have a lot of money in a margin account. Within 2 months, month and a half, it was $54,000. Yeah. So think about that from a hedging standpoint. That's just silver. What about gold? What about platinum? There are a lot of things that go into this to be able to be here to provide the service. It's not as easy as just, setting up shop and saying, well, here we go. You want to protect your inventory, run a good business, pay for insurance, which keeps on going higher, everything. There's a lot involved, but I will tell you that I've never seen premiums like this in my career, and I think it's an anomaly, and it'll go back to where it was. You get big participation in this industry from the public, even just a 10% increase. Mm-hmm. and all of a sudden you'll see premiums shoot the other way, and then it changes. And then look at things like you get China saying we're going to limit export of sulfuric acid, which is the main component in that is involved with copper mining. And silver is its main byproduct is mining of copper and lead and zinc. 20% of what came to market of the 850 million ounces, and again, this will be the 7th year in a row of a structural deficit between supply and demand in mining, over 200 million ounces. It's funny because I just read that. I think I wrote it down. Let me just see the actual number. If I didn't, forgive me. I thought I did. But basically, there are two different numbers. The Silver Institute is saying 70, 80 million ounces short this year. Here it is. UBS estimates 293 million ounce shortfall. Metals Focus 76.3. I believe UBS over Metals Focus 1,000% for many reasons. But the point of it is we're seeing a deficit in mine supply. And, you know, when of the 850 million ounces mined last year, only about 180 million came from companies like Keith's, who primarily mine silver. The rest was byproduct, where there is no financial incentive to go looking for silver in copper and zinc and lead. And if copper is now going to be curtailed because you can't get as much in the way of sulfuric acid, all of these little things chip away at the thesis. And the thing of it is that, you know, the price that has been controlled by the West forever make people think silver is no big deal anyway. If there were no manipulation on COMEX, if there was no short selling allowed, if the rehypothecation and the over levered markets weren't distorting the reality of how rare and valuable and what a necessity silver is, which most commodities have one use. Silver, it has multiple uses in military, in electric, industrial, electric, electronic, water purification, medical devices, and monetary. It's got plurality of uses. It's diminishing in supply. It's increasing in demand and in uses. It's more valuable than the price would ever dictate. And that's why you see China, when its teeth gets kicked in, that being the price of silver, buy more 2 months in a row than ever before. India import 900 million ounces. That's why you're seeing these countries quietly, and whoever's doing it here in the United States, quietly use price as a tool of misdirection. And if you all don't think that is something that happens all over the place, misdirection is a very common tool in high-level finance. You misdirect through price and rhetoric and stand for delivery. And that's what they're doing.
Gold and silver demand is surging in 2026, pushing prices to record highs driven by intense safe haven buying amid geopolitical uncertainty, inflationary pressures, and strong industrial demand. Combined with growing concerns over counterparty risk and de-dollarization trends, the long-term outlook for both gold and silver remains structurally bullish, with tightening supply conditions adding further support to prices. While short-term volatility has been driven by structural factors such as margin adjustments and ETF rebalancing, the underlying trend remains strongly supported by persistent accumulation from China and central banks. If physical demand from central banks continues to rise while paper markets remain heavily leveraged, could the gap between price and real supply eventually force a major repricing of gold and silver? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.